Welcome everyone. It's just about 11:30, so we're going to get started. My name is Danielle Lund, and I serve as Associate Director of Digital Engagement for the Alumnae Association at Mount Holyoke. Our work at the Alumnae Association is all about providing meaningful resources and opportunities for members of the Mount Holyoke community to connect. I want to share that registered for today's session are 135 community members. If you feel comfortable doing so, we encourage you to share your name, your class year, or your affiliation to Mount Holyoke in the chat box. It's really great to be with you all today. I want to briefly remind that we're recording this session and that no other recording is permitted. If questions come to mind throughout the presentation, you can go ahead and enter those in the chat box. We're going to address as many as we can at the close of the presentation. And at that point, we'll also, if folks want to raise their hand and vocalize a question, we'll handle it that way during the Q&A. We're very happy to have with us today Certified Financial Planner Gillian McCarthy, who's an alum of the class of 2012, to share her insights on financial planning and readiness. So Gillian, welcome and thank you for being with us. I'm now going to turn things over to you.
Great, thank you, Danielle. And thank you to the Alumni Association for putting together this series. I think it's a great opportunity for us to teach and to learn from one another. So thank you, Danielle and Megan and the entire Alumni Association. So as Danielle said, my name is Gillian McCarthy, Certified Financial Planner. I graduated from Mount Holyoke with the class of 2012. And while I was at Mount Holyoke, I majored in economics and I minored in Spanish. After Mount Holyoke, I relocated to southeastern Pennsylvania, where I'm currently living today. And I'm going to begin sharing my screen now, and we can jump right into it. So the topic of today's conversation is everything financial, what I wish I knew then. And to get a small compliance piece out of the way early on, I will say that the material that we're going to discuss today is not intended to be construed as tax, legal, or investment advice. Now, the whole reason behind this conversation today is a culmination of trends that I've noticed over the course of my career working with clients. So over the course of my career, I've worked with high net worth clients, individuals, families, and small businesses. In those conversations and analysis and financial planning, I've noticed trends that had they known these pieces of financial knowledge or wisdom earlier on in their careers, they may have made different choices and altered their financial picture. Now, these trends can really be culminated into three broad categories of what I wish I knew then: strategic accumulation, employer benefits, and major goals. We'll start with strategic accumulation. And what this really refers to are two primary pieces of laying the foundation and the fact that location matters. So strategic accumulation, what does that mean? Well, over the course of your working career and over the course of your life, you're going to have different phases. In the first 10 years of your career, which is what this conversation is really geared towards, you're going to have the opportunity with time on your side to make decisions to allow you to accumulate strategically. So let's pause here and use a poll question to see where everyone is in their career. So Danielle, if you don't mind bringing up poll question number 1, which is how many years into your career are you? I'm interested to see where everyone is in their careers. So response A is 1 to 2 years, B, 3 to 7 years, C, 8 to 10 years, or D, 10 plus years. So if you could please reply with what category best fits your current situation. Okay, across the board here, So what we're seeing is that most are within the 10 plus years, so 35% are 10 plus years, 16% are in 8 to 10 years of their career, 24% are within 3 to 7 years, and 24% are in the first 2 years of their career. Fantastic, thank you. And we'll use polls throughout this conversation as we move along. So strategic accumulation. What I've found is that the decisions that you make early on in your career lay the foundation. If you think about your financial picture as a house, you cannot decorate the walls, you cannot choose paint colors, you can't rearrange furniture if you don't have a floor, because there will be no walls, there will be nothing to decorate. That's what laying the foundation is in your financial life. Build yourself a solid base with an emergency fund is the lesson that I have seen as a common trend. Every single plan that we do, no matter where the client is in their financial journey, we talk about an emergency fund. It is that important. What is an emergency fund? Well, an emergency fund refers to a bucket of money that you have set aside to cover 3 to 6 months worth of expenses. Well, that's quite a range, 3 to 6 months. Where you fall on that range depends on your particular situation. Whether you're a sole breadwinner, whether you have multiple income streams, whether your job is stable or not. You need to make the determination of where you lie on that 3 to 6 month range. Now, the second piece is expenses. That term can be a bit ambiguous and a bit confusing, whether you're determining discretionary or non-discretionary expenses. So it's important to actually bucket those expenses together. The way that we look at emergency funds is to consider both types of expenses. Discretionary, meaning the fun expenses. These are things that you could do without. They're more wants than needs, whether it be restaurants, entertainment. And then non-discretionary, on the other hand, these are the expenses that you must make sure are covered on a regular basis, because these are the types of expenses that keep life functioning as normal, keep the roof over your head, keep the lights on type of expenses. To bucket those two types of expenses together when considering your emergency fund, you're building a buffer for yourself. As the saying goes, you have to expect the unexpected, right? I think 2020 has driven that point home for each and every one of us. As you move through your career, as you move past that 10-year mark in your career, reevaluating your emergency fund. Are you overfunded? Is your target still in line with reality? Are you underfunded? These are things that we need to evaluate on a regular basis, because you have to expect the unexpected. This is the foundation for your financial picture. Once you've checked that box, then you can start to think about the more strategic pieces. But let's take another poll here. Now, completely anonymous, no judgment whatsoever. How much do you have saved in your emergency fund? We can compare our results to this survey here on the screen, which is the results of a 2018 survey that Bankrate ran. And I'm interested to see how we compare, because we have a pandemic under our belts and 2 years since this survey has been run. Great, so the results are coming in now. And again, the question is, how much do you have saved in your emergency fund? Response A is none, less than 3 months is B, C being between 3 and 6 months, and D more than 6 months. Now, what the results are showing us is that we have quite a range. So 14% saying none. They don't have anything saved specifically in emergency fund. 26% have said less than 3 months worth of expenses. 24% are replying between 3 and 6 months worth of expenses, and 35% of our audience today has more than 6 months worth of expenses set aside specifically in emergency fund. Now, comparing that to the 2018 results of the bank rate survey, we can see those results were equally across the board. The bank rate survey included another category of don't know, which is something we don't have in our poll, but some savers across America simply don't know because they have not looked into their financial picture. By building your foundation, you're eliminating that as a possible answer because you're going to have a clear financial picture as you move through your career and your life. So once you've checked the box of building your foundation with that emergency fund, you can become more strategic in where you're saving. So once that foundation is laid, we need to start paying attention to location. You've probably heard the term asset allocation. Well, this is in regards to asset location. There are many different types of accounts. It can almost be overwhelming. So they range from your standard checking and savings accounts to non-retirement accounts, they're called taxable accounts, to a whole slew of different retirement accounts, ranging from traditional IRAs, 401ks, Roth IRAs, to small business savings plans such as simple IRAs or SEP IRAs. Where you save matters because each of these types of accounts are treated differently in terms of taxes. So how you're saving will impact your tax picture now and more importantly in the future. The reason why I say this is this chart summarizes it nicely. So what this is showing us is that there are 3 different phases. So as you're putting money into an account, those are your contributions. As the money is growing, your pot is growing, that's growth in the account. Then as you take money out of the account, those are the distributions. Now, depending on what type of account you are saving in, it will be treated differently from a tax perspective. And to drive this point home, I was meeting with a couple recently and I completed a financial plan for them. Running out of money is never going to be their problem. They've saved extremely diligently. They have a very strong financial picture. But what I found in my analysis is that they saved almost exclusively for retirement in a traditional IRA. What does that mean? It means when they're contributing to the traditional IRA, that money was tax deductible. As the money grew in the traditional IRA, it's tax deferred. Great. But when they move into retirement in just a few years and they begin taking money out of the account, those distributions will be taxable. So they've created a tax problem for themselves. They approached their financial picture thinking they were being very streamlined and efficient by only having their retirement savings housed in a traditional IRA. However, they created a problem for themselves because they did not pay attention to asset location. So this is a fundamental piece as you begin building your wealth, as you begin your strategic accumulation, paying attention to where your money is being saved to build diversification so that you have multiple buckets. You have flexibility when you get to that ultimate goal of retirement. Now, taking a step back, within the first 10 years of your career, you're going to have so many decisions to face. What employer are you going to go with? What are going to be your selections within your employer benefits? How are you going to shape your career over the course of your lifetime? For most of us in the first 10 years of our career, employer benefits are a major piece of our financial picture. And this is going to look very different whether you are in the private sector, whether you're working for a nonprofit, or whether you're a government employee. Your options are going to be different. However, what I've found in working with clients ranging from individuals, families, high net worth clients, and small businesses is that there are four main categories where people wish that they had known a piece of financial knowledge earlier on in their careers. When it comes to employer benefits, they really fall into these four categories: retirement savings, health savings accounts, insurances, and student loan repayment programs. Now, retirement savings, it feels and it sounds far away when you're in your first 10 years of your career. However, I can't tell you how many times I've heard, oh, I wish that I had saved earlier, or I wish I knew how to save more often, and I hadn't left money on the table early on in my career. I've heard that so many times. Health savings accounts. These are a particular type of account that are available with a particular type of health insurance. I've been hearing this on an increasingly frequent basis, that people wish they had known that these can be used not only for health expenses, but also a long-term savings option. And thirdly, insurances. Insurance is a huge part of employer benefits. So knowing to shop outside of your employer plan for life insurance. This is a piece that many people coming to me for a financial plan have missed over the course of their career. And lastly, student loan repayment programs. This is not a core component of employer benefits, but it is on the rise. These types of fringe benefits, if you will, do add up. So not only when you're comparing job offers, but when you're in the negotiation phase and evaluating what is the best fit for you, doing a deep dive into the offerings and finding what is most valuable to you, not only will allow you to align yourself with the right fit, but allow you to maximize the financial benefits available to you. So let's take another poll now. And this will be poll question 3. The question will be, which employer benefit would be most valuable to you? So the options are a retirement savings match, health insurance options, including a health savings account, or lastly, a student loan repayment program. I'm interested to see what would be most valuable to you, because we do have quite a range of where people are in their careers. Great. So we have quite a number of responses coming in towards the retirement savings match. Fantastic. So the results are showing us that the retirement savings match would be most valuable by 66%. Health insurance options, including a health savings account, will be second most important, 20%. And then for 14% of us, a student loan repayment program. Fantastic. So let's dig into retirement savings, since that was such a hot topic for us. Now, I cannot underestimate how often I've heard that people saying they wish they knew how to start saving for retirement earlier on in their careers. It can be overwhelming within the first 10 years of your career with all of the decisions that you are faced, not only within your employment, but getting your life started post-college. Now, the most common wish that I hear about retirement savings is they wish that they had known to save more often, earlier, and not left money on the table. What I mean by not leaving money on the table refers to employer matches. There are a lot of decisions when it comes to how to save for retirement savings. So let's take it one step at a time and give you a bit of a framework here. So the first question is, well, how much should I be saving for retirement? Okay. Well, let's start with the concept of the employer match. This is a good introductory rule of thumb. It likely will not be enough for you to simply save to your employer match. Number one, because not every employer that you work with over the course of your career will offer an employer match. What an employer match is the idea that when you're saving to an employer-sponsored retirement plan, an employer may offer, say, 100% of the first 3% that you are contributing. So, for example, if you contribute 5% to your employer plan, what that means is you will be receiving your 5%, great. You'll also be receiving the 3% that your employer is matching, and that's coming out of their pocket. And that's very important because it's maximizing what you're saving early on. And you can build on that because within your retirement account, you'll be investing. That comes into play with the idea of compound interest. You're building upon what you're saving. The more often that you can save, the earlier you can save, the longer that you have to build. Now, secondly, budgeting. Now, this is a word that a lot of people don't make synonymous with fun, and I completely understand that, but it is fundamentally important to make budgeting a routine and regular part of your habits. It doesn't have to be pen and paper. Could be Excel, could be a website. There are so many websites today that allow you to do budgeting and do all of the heavy lifting for you, that it's not such a chore. There is mint.com, that's a free option. Personalcapital.com, another free option. YouNeedABudget.com. They often offer free trials, then it does come with a cost. The way that these websites work is they link to your accounts, they pull in all of your transactions, they categorize those transactions for you, and then they will allow you to make some adjustments. You'll have some correcting to do along the way. As you use this budgeting software, pen and paper, Excel, you'll begin to see trends. The first trend that you'll see is, well, what's left over at the end of the month? Very important, because after your emergency fund is funded, you're saving strategically, bingo, you just found additional dollars that you could be saving on a regular basis towards retirement. Secondly, what budgeting allows you to do is see trends. You can begin to see positive and negative trends before they become habits, but you can be more intentional with your financial picture. And as I said, budgeting does not have to be a chore, but it is a requirement. The more that you make it a routine, it will become a habit. You're going to build your gut sense of your spending, and this will allow you not only to make more strategic decisions, but it eases the whole financial planning process for yourself. It's fairly shocking, actually, how often I'll ask someone, well, how much do you spend on a monthly basis as part of the financial planning process? And they simply don't know. It doesn't matter what phase of your career you're in, budgeting is an important step along the way. Now, let's take a look at compound interest. So what this chart is showing us, this is simply reiterating the importance of the idea of saving frequently, early, and not leaving money on the table. So this is showing us the impact of starting with $1,000, contributing $6,000 every year for 30 years. And it's assuming that that money is invested and it's earning an average of 8%. Well, this chart, the blue color, this is showing you $1,000 and $6,000 is being added to it. It's not assuming the growth. It's not assuming that it's invested. The green is showing the impact of the investment, the growth over time. So what you're ending up with is a future balance of over $788,000. This is the magnitude of saving early, often, and not leaving money on the table as you're investing in your employer plan, because you will have the opportunity to grow your wealth over the course of your career. Now, the next phase of employer benefits are insurances, and specifically within insurances, health insurance. Within health insurance, there are a particular type of account called health savings accounts. You may hear me refer to them as HSAs. We love to see HSAs. When we see clients that are contributing to an HSA, we give them double thumbs up, because an HSA is a wonderful type of account and an extremely unique type of account if it fits in with your financial picture. Recently, I was meeting with a client who he does a ton of reading, listens to personal finance podcasts. He considers himself very well versed on personal finance. Now, we met to do a financial plan as he's approaching retirement. And one wish that he told me right off the bat is that he wished he had learned and read up on health savings accounts earlier on in his career. He only learned about them last year and only realized that they would be a good fit for him last year, therefore missing out on many years of saving into a health savings account because he was a good fit for this type of account. In order to have a health savings account, you must be enrolled in a high deductible healthcare plan. That's a particular type of health insurance. Generally makes the most sense to use this type of plan when you're healthy, have fairly low expenses in terms of healthcare and prescriptions. And he fit this bill perfectly. I really couldn't think of a better solution for him. But he simply did not know that it existed, and he didn't realize the value of a health savings account. Now, we love HSAs because they are a trifecta. They're triple tax advantaged. What does that mean? Well, let's take a look at this chart. So we have our traditional IRAs, we have our Roth IRAs, and then we have health savings accounts. So if we think back to the asset location and think about tax treatment, traditional IRAs, when money is going in, those contributions are tax deductible. The money grows, and then when you take the distributions, that money is taxable. Vice versa for a Roth IRA. As you contribute, those contributions are after tax. The money grows in the account, then you begin to take the distributions, those are tax-free. So we have red on one side of each of those types of accounts. But you'll see with HSA, we have green on both sides of the account because they are trifecta accounts. They're triple tax advantaged. Money going in is tax deductible. Money growing within the account is tax deferred. And money coming out is tax free. Now that's extremely unique. There are not many other types of accounts that offer the trifecta. And that's why we love them so much. Yes, it's true that you have to be in a particular situation to be eligible for the HSAs, and they only make sense for certain situations. But in your first 10 years of your career, it is something to keep an eye out for, because as you know, many of us have multiple stops along the way in our careers, and HSAs are portable, which is very important. They move with you throughout your career. So if you leave your employer, you've built up a balance in your HSA, that's fine. You can take the HSA with you. You're not leaving it behind. You're not leaving any money on the table because they go with you throughout your working career. Insurances more broadly are a significant piece of the employer benefit picture. Most people, I would say, are not comparing life insurance benefits when they're comparing employers of who they're going to go with. However, the availability of your insurance lineup within your employer benefit package is incredibly important when the time comes to use it. Many people mid-career have expressed to me the fact that they wish that they had paid more attention to their employer benefits and what they did and did not offer earlier on in their career. And this point is really driven home by a situation that I've seen countless times. Specifically, I was working with a couple. They were in their late 40s. They both were employed and had relied heavily on their employer benefits, specifically for their life insurance. Most employers offer some multiple of your salary for the life insurance, whether it be 1 times your salary is the life insurance benefit, maybe 1.5 times your salary will be your life insurance benefit. Well, this may or may not line up with your actual life insurance need. And this couple that I was working with found this out quite dramatically. Early on in their career, they had each purchased a small life insurance policy just to be on the safe side. It covered them at that point in their career. But they both received several promotions and acquired some debt. So they had some property purchases and their life insurance needs grew dramatically. Well, in my financial planning analysis, I uncovered that they were dramatically undercovered for life insurance. Well, I don't sell life insurance, but I recommended that they meet with a few life insurance brokers to start shopping for policies and start the underwriting process. And they both thought that they would pass with flying colors, being in their 40s. But what happened is one of the two ended up not passing the underwriting because they failed for medical reasons. And so they were dramatically underinsured and not able to get life insurance on this one individual because they kept failing the medical underwriting. Now, what they had, of course, wished at that point in time is that, number one, they had reevaluated their insurance need on a more regular basis, and 2, that they had not procrastinated on actually shopping for life insurance outside of their employer benefit. By shopping for life insurance outside of your employer benefit, just like an HSA, you're adding a sense of portability. As you move from employer to employer, if you've purchased your own individual policy, that goes with you. It's certainly not tied to your employer, unlike employer-provided life insurance. So reviewing your needs and what is available to you on a regular basis will strengthen your financial picture. Because as you move through your career, you're aging. As you age, health issues become more common and more prevalent, making the underwriting process slightly more challenging potentially. The last employer benefit is student loan repayment. Now, very few employers are offering student loan repayment programs today. However, it is on the rise. From 2018 to 2019, the number of employers doubled. When I say doubled, keep in mind it went from 4% to 8%. So there's still quite a ways to go before this is a commonplace benefit that you see in a core lineup. Why this is so important is going into your career with the weight of student loan debt can be monumental. It can delay some of your major goals that you may be planning for. By evaluating what benefits are available to you, what benefits employers in your industry are offering, can help you make a decision of who is the right fit for you in terms of employment and who is going to help you build the financial picture that you want for yourself. As we all know, the student debt crisis in America is monumental. as this chart shows, the average student loan debt, $1.6 trillion. That's both private and federal. The average federal student loan debt is over $36,000. Going into your career with that level of debt can be an incredible weight on your shoulders. Aligning yourself with one of those employers who does offer a student loan repayment program can help you lift that weight and make the job all that much more valuable to you and your financial picture. All of these decisions that you're making along the way lead you to major goals. At J.H. White Financial, the way that I work with people is both through financial planning and investment management. One of the major reasons why people come to us for financial planning help is planning around a particular major goal. Within the first 10 years of your career, your major goals may range from a primary property purchase. Perhaps it's education savings for a child or a future child, or that ultimate goal of retirement. Now, over the course of my career, what I've seen in terms of trends, what people wish that they had known earlier on in their careers for primary property purchases, is the idea that there's not one path. You have the ability in today's economy to get creative. And when you're getting creative, you need to use a trusted team. Education savings. What many people wish is that they had started saving before their child is born. Many people don't realize that you do have the ability to begin saving before your child is even born. Then lastly, that ultimate goal of retirement. You can make all of the right financial decisions along the way, but now that you have the time on your side, you have the opportunity to start visualizing your desires in retirement now. So that is the complement to all of these decisions that you're making in your financial picture, is adding that sense of intentionality to your decisions. So you're visualizing your path as you get there. That visualization will change, it will evolve, and continue working on that, because that's the reason why you are making all these financial decisions, is to eventually get to that ultimate goal of retirement. So as I said, primary property purchases today allow for a bit of creativity. There's not one singular way to get into your home. Today, I'm seeing house hacking becoming more and more common. So house hacking is the concept that you're turning a major debt, which is a mortgage, into income. So instead of buying your traditional single-family home, in the concept of house hacking, you may purchase a multi-family home. So let's say it's a duplex. So I've had clients who've purchased a duplex, live in one unit, rent out the other unit. That income from the second unit then covers the mortgage. So they're essentially living rent-free. What does that also mean? It means it's their primary residence. When they are preparing for the purchase, as it's a primary residence, they are required to put less down because it's not investment property. As they're living rent-free, what does that do to their budget? It frees up more cash flow, allowing them to save more. What they're doing with that savings, they may be saving towards a second home. They may be saving more towards retirement. They may be saving for another goal. But it's being creative with how you're getting into your first home. Now, house hacking is certainly not for everyone. Right? You have to be in a set of circumstances in order for it to work. You have to be willing to live as a landlord. You have to be willing to take on that responsibility as a landlord. And you have to be willing to live perhaps a bit unconventionally. The trusted team aspect of a primary property purchase falls in line with everything else financially. Having the right people on your side makes an incredible difference. Of course, you have your realtor in your corner. You also need to pay attention to your mortgage broker. You likely have a banking relationship. That bank may have a mortgage broker, it may have a loan officer, but shopping for the right mortgage broker for you is important, because not only can you shop interest rates, but you can shop who is going to be offering you the best loan product for what you are trying to accomplish. It's always a good idea to have a complete team on your side before you enter the arena of a primary property purchase. In years like 2020, the housing market is on fire right now. Sellers are putting their houses on the market, particularly in southeastern Pennsylvania, and receiving multiple offers, perhaps above the asking price, within several days. So houses are just flying off the market. So to be more competitive, not only are you building your team to help you in the negotiations, but you're approaching the offer with a pre-approval letter. You're going to be considered more seriously, and you'll be a more competitive buyer. Now, moving into a second goal that we see incredibly frequently is education savings. Education savings can be a monumental goal, whether you're saving for multiple children, maybe it's a future child. As we saw with the summary of student loan data, education savings is a monumental goal. There are ways to begin saving for this even before a child is born. So just like retirement savings, there are ways to save early and frequently, and that's through what's called a 529 account. A 529 account is designed specifically for education savings. While there might be a bit of hesitation, you're saving for someone who's not even born yet. You don't know what their goals will be, what their interests will be, and the 529 does allow for a bit of flexibility there. If your child is born and they move through school and determine that they are not going to be attending college, that's okay. A 529 can be transferred to another family member, whether it be a sibling or a first cousin. So you're not losing those funds, ultimately, if the child decides not to go to college and takes another path. It's not a lost bucket of funds at that point. The benefit to saving early and frequently into a 529 account instead of another type of account is that 529s allow for you to take money out of the account for qualified expenses on a tax-free basis. So that is a very real and very important understanding of the 529, is that the qualified expenses range from enrollment, could be books, fees, supplies, some cases room and board. And today, 529s may actually be used for some pre-college expenses, for K, so kindergarten through 12th grade tuition, for up to $10,000 per year. Now, what happens if you need to tap into this type of account for something other than education expenses? Well, it is still possible, certainly not advised, and you would be penalized. As a parent, you could withdraw money from the 529 at any time, really for any reason, but you would be penalized. You'd be incurring income tax, and you'd be hit with a 10% penalty on the earnings portion of the non-qualified distribution. So in order for this type of account to truly see its benefit, you need to be using it for a higher education expense. And then lastly, this is the summation of everything that we've talked about thus far: retirement. As you're moving through your career, you're making the strategic, informed decisions to eventually get you to retirement. This most sad moment that I've ever had when working with a client is that moment when I'm sitting across from someone, we're working on a financial plan, and I ask them, well, what are you going to do in retirement? And they just kind of look at me with a blank stare and they say, I don't know. Well, that's a cliff dive type of experience because they've kept their nose to the grindstone their entire career. They've worked away diligently, but they haven't done the planning for what that second phase of their life is going to look like. And it's a lack of intentionality at that point. So now that you are in your career, you have time on your side, I would highly encourage you to take the time and do some planning, not only for your finances, but for your vision, so that you have a sense of intentionality. So I'm going to pose 3 questions to you. I encourage you to write down the answers to these questions and take these with you. These are questions you should revisit throughout your career because you'll notice that your replies or your responses evolve over the course of your career. And these are questions that have been posed by a gentleman by the name of George Kinder. He's a prolific personal finance author. The first is a scenario. I want you to imagine that you are financially secure. You have enough money to take care of your needs now and in the future. The question is, how will you live your life? What will you do with the money? Would you change anything from what you're doing today? So describe this in as much detail as you can to describe a fully complete life. The second question is another scenario. This time you are visiting a doctor. So in this doctor office, you are told that you only have 5 to 10 years left to live. The good news is you won't ever feel sick. There will be no terrible symptoms to go through. However, the bad news is you will have no notice of the moment of your death. So what would you do in the time remaining? Will you change your life? How would you do it? Thirdly, this time the doctor now shocks you. So this is more of a serious situation. You receive the news that you only have 1 day left to live. Notice what you begin to feel. Ask yourself, what dreams have you left unfulfilled? What do you wish that you had done? What do you wish you had been? What are you most going to miss? So as these questions progress in the scenario, I highly encourage you to take notes of your responses. You can Google these questions. In 5 years, these will still be out there, the vision planning questions by George Kinder, and revisit your responses. It'll be interesting to see how these questions evolve over the course of your career and over the course of your lifetime. And in summation, I hope that you take these financial planning tips and guidelines to build upon your existing financial knowledge so that as you move through the course of your career, you can build the financial picture that you want by making strategic decisions and informed decisions. And thank you very much for your time today.
Thanks so much, Gillian. This was great, and it's good to see all the chat going on throughout the event. At this point, we encourage you, if you have questions, to drop those in the chat box, and we'll do our best to address as many that we can. I did see one come through during the session, just curiosity more about stipulations around HSA. And the thought, don't you lose your HSA if you don't spend it? And I'm wondering if you might be able to speak a little bit more to HSA in particular.
Sure. Now, HSA is very different from FSA, and at times they can be confused. In FSA, you may lose HSA, health savings account, is portable. So you don't necessarily lose that. My husband, for instance, he had an early HSA from a first employer. He had forgotten about it. Shame on him being married to a financial planner, and recently revisited it. He was then able to access it and use it for medical costs.
Awesome, thank you. So feedback, super helpful presentation. Super helpful presentation. Do you have advice on finding employers who might be able to offer student loan repayment, since that might be a fringe benefit? Like, do you see any industries where that's more popular, or organizations where that's more popular?
It does tend to be with the major organizations. I will tell you that nerdwallet.com just put out a list in 2020 of organizations that are offering this. So if you Google NerdWallet student loan repayment program, I'm sure it will be one of the first search results that you'll find. And because this is becoming a more widely demanded benefit, this is going to be something that's reported on more frequently. And I'm sure we'll be seeing lists published on an annual basis.
Awesome, thank you. So thanks so much. Can you share, can self-employed people have an HSA?
That's a great question. HSAs are available for those who are eligible. Those who are eligible are enrolled in a high deductible healthcare plan. So if you have access to a high deductible healthcare plan, you can be enrolled in an HSA. And you have to be incredibly careful with this, because we have seen firsthand clients thinking that they're in the proper type of healthcare plan and thinking that they can contribute to an HSA, planning around it, and then come to find that they do not have the ability because they're not in the correct type of healthcare plan. So do pay very close mind to your eligibility. If you are unsure, reach out to a financial advisor in your area. As a self-employed person, you don't have the benefit of a HR team, right? So you may have to reach out to a few sources in order to help you navigate some of those waters, because the regulations are very strict with the HSA eligibility.
And Gillian, just because you brought it up HR, I'll mention that our first webinar of 2021 is navigating HR during COVID and beyond. So it might be
I love it. That's great.
A moment to tune in, maybe to bring that question to that event also.
Absolutely.
So I see here a question about retirement accounts from two different jobs, so an old job and a new job. And let's see, my retirement rep from my new job is encouraging me to consolidate, but I'll be charged a significant fee if I withdraw from my old retirement account to consolidate. But also I'm charged a smaller fee for every year I don't contribute to my old job's retirement account. Any thoughts on best practice there?
So the question is posing, what should you do when you have multiple retirement accounts? Should you move from the old one to the new one? There might be fees involved. The idea of consolidating, in theory, is great, right? Simplifying your financial picture. But what Diana is mentioning here is the potential for fees. So I would be very careful here. I don't know the full picture, so I'm a little hesitant to give specifics. But the idea of moving from one retirement account to another is very important if you have the ability to roll over. It must be coded as a rollover. So you do have the ability to move from an old employer plan to a new one without taking the money out. So if you're moving from a 401k to another 401k, like to like, that's very, very common. The fact that there are fees involved here causes me to pause, and I would do a bit more investigating, Diana, to see what's behind the scenes here.
Awesome. Thank you so much for your insight there. So another remark, thanks so much for the presentation. For recent grads following a Roth IRA, what are your recommendations for putting savings? At what point should you start to think about diversifying your investments?
So the question is, when do you start thinking about diversifying your investments? Day one.
All right.
The fact that you are already thinking about diversifying your investments is great. And where should you put your savings? So within the investment industry today, we've seen a race to the bottom in terms of fees. So what you'll notice is with the major providers, you're going to see low cost investment options. And that is a fantastic thing for all of us, right? Because you have the ability to reduce costs and to diversify. There are options out there called ETFs, mutual funds, and it's a whole basket of goods. You don't need to pick one stock over another. Instead, you could use an ETF or a mutual fund and gain that broad diversification or that broad exposure. Taking it one step back, there are funds that are called target retirement funds. So as a recent grad, you may be looking at a target retirement date that's way out, maybe 2040 or 2050. A target retirement fund allows you to pick your target retirement date, and it assumes that since you're so far away from that date, you're going to be investing fairly aggressively. So there's going to be a lot of stocks involved in that fund. And as you get closer to that retirement date, gradually over time, the stock exposure will reduce, the bond exposure will increase. What that does is it allows you diversification, and it allows you to have risk reduction over time. So it's a bit of a hands-off approach, but that's one way to go about diversification if you don't want to be picking the particular funds that are making up your portfolio. Or, of course, you could be working with an advisor too to help you along the way.
Wonderful. Thanks so much. So it looks like we've covered most of the questions that come in. So this is where we're gonna close things off for today. Gillian, thank you so much for all the time and thought put into this presentation. For folks who have joined, we so appreciate your good questions and comments. I'm gonna drop in the chat box here. This is the link to where you can find our upcoming events and where we post the recordings of our past events. So we encourage you to take a look there. We have a lifelong learning event on oil painting going on next week. In the new year, we're doing a career skills mini series. So we encourage you to take a look and join us. We're also excited. Next week, we're going to be announcing a new online connection platform for getting in touch around career and life growth called The Gates. So please keep an eye out for that message. We're really excited about it. But again, Gillian, thank you so much. To my colleague Megan, who's been on backing up today, thank you so much, and wishing everybody a great day. That's all, folks.
Thank you.